Welcome back! We are diving right into the fifth and final explainer in our ASC 360 series. Today is all about the grand finale of the asset lifecycle, how property, plant, and equipment officially leaves the balance sheet. We've acquired our assets, estimated their useful lives, run depreciation, and tested for impairment. Now we have to determine exactly how an asset makes its final exit.
Here's our roadmap for today. We'll start with leaving the balance sheet, then dive into held-for-sale classification, move on to disposals and derecognition, and finally wrap up with financial statement presentation.
All right, Section 1, leaving the balance sheet. Let's look at the two exit pathways.
So, an asset's time is up, but there isn't just one single way it says goodbye. It entirely depends on management's intent. On one side, we have the planned exit or held for sale. Think of this as the asset sitting in a sort of accounting waiting room. Management has committed to selling it, but the actual transaction hasn't happened yet. Then, on the flip side, we have the immediate exit or disposal. This is swift and permanent. The asset is sold today, or it's simply scrapped or abandoned. Boom, it is off the books entirely. Let's dive into that planned exit first.
Moving to Section 2, held for sale classification, also known as the planned exit. Now, the absolute most crucial thing to understand about held for sale is the all-or-nothing rule. You see these 6 criteria? If even one of these fails, the asset stays right where it is in normal PP&E. So let's walk through them. First, management must formally commit to a plan to sell. Second, the asset has to be available for immediate sale exactly as it sits right now. You cannot be planning a massive overhaul before handing it over. Third, you've initiated an active program to locate a buyer. No just crossing your fingers. You have to be actively looking. Fourth, the sale needs to be probable within the next 12 months. Fifth, you're marketing it at a reasonable price relative to its fair value. And finally, number 6, it's highly unlikely that management is going to suddenly change their minds and scrap the plan. Remember, it's a lock-and-key situation. You absolutely need all 6.
Once you actually meet all 6 criteria, it triggers a massive shift in how you account for the asset. First off, depreciation ceases immediately. Why? Because you're no longer consuming its economic benefits through use. You are literally just waiting to sell it. For measurement, it shifts to a strict lower of cost to market test. You value it at the lower of its carrying amount or its fair value less costs to sell. If that fair value minus selling costs drops below your carrying amount, you take a write-down, which is recognized immediately as an impairment loss. Now, if the market improves later, you can recognize a gain, but only up to the amount of the cumulative write-down you previously took. You can't ever write it up higher than its original carrying amount. And finally, over on the balance sheet, because we expect to sell this within 12 months, it gets bumped out of non-current assets and gets its own separate line right up in current assets.
All right, on to Section 3, disposals and derecognition, the immediate exit.
So this is the rip-the-bandage-off approach. No waiting room, no purgatory. The asset is officially disposed of, and it's time to derecognize it entirely. To figure out the financial impact of this permanent exit, we use this exact formula for the income statement. You take the cash you received, meaning your proceeds, and you subtract the asset's net carrying amount. Just as a quick refresher, that net carrying amount is the original cost minus all accumulated depreciation minus any accumulated impairment. The difference between the cash you got and what's left on the books, well, that is your gain or loss.
Depending on how that math shakes out, your journal entries are going to follow one of 3 distinct disposal scenarios. If your proceeds are higher than the net carrying amount, obviously, you book a gain. If your proceeds are lower, you're booking a loss. But what about scenario 3? Say a piece of heavy machinery completely breaks down, it has 0 resale value, and you literally just haul it to the scrapyard for nothing. Well, in that case, your proceeds are 0, so the entire remaining net carrying amount becomes your loss on abandonment.
Okay, I need you to pay close attention to this next point, because using gross cost instead of the net carrying amount is hands down one of the most common disposal errors in all of accounting. When you record a disposal entry, you absolutely have to clear out the historical garbage. You must remove the original gross cost of the asset from your books, and you must simultaneously remove the accumulated depreciation tied to it. The gain or loss calculation is based solely on the net carrying amount that's left over. If you try to calculate your gain or loss against the original gross cost, your math will be completely wrong, and your balance sheet is going to be left holding these weird orphaned accumulated depreciation balances. Always flush out both.
Let's wrap things up with Section 4, financial statement presentation. We are following the money.
This table is basically your ultimate cheat sheet. Let's map exactly how PP&E, depreciation, and disposal proceeds find their final resting places across the major financial reports.
On the balance sheet for your long-term, non-current assets, PP&E is presented at its net carrying amount. So that's gross cost less accumulated depreciation and impairment with the major categories disclosed in your notes. If we shift up to current assets, that's where you'll find those held-for-sale assets broken out separately, assuming you're selling them within 12 months. Now, looking at the income statement, your everyday depreciation expense typically sits right in operating expenses. Things like COGS for manufacturing equipment or G&A for office computers. If you take an impairment loss, that gets its own separate line within operating expenses, and those gains or losses on disposal, they can land in either operating or other income and expenses. Finally, we have the cash flow statement, which ties it all together. When you buy PP&E or receive proceeds from selling it, that's an investing cash flow. And all those depreciation and impairment charges, since they don't actually cost you cash today, they are non-cash add-backs in your operating activities. Oh, and a quick tip, if you capitalized any interest during construction, that actually counts as part of the investing outflow.
As we close the books on this final ASC 360 explainer, ask yourself, are there ghost assets hiding on your balance sheet right now? Are your teams strictly calculating disposal gains and losses off the net carrying amount, or are they falling into that gross cost trap? And are you rigorously checking all 6 criteria before classifying something as held for sale? Getting this right is what separates a beautifully clean balance sheet from an absolute audit nightmare. Thanks for joining me for this series, and keep those books pristine.